Leading to a 25 basis point rate hike. That was ECB President Christine Lagarde in Frankfurt, Germany. This is Bloomberg's The Open. I'm Jonathan Ferro. And here's your market 10 minutes into the session stateside. Equities up by 0.5% on the S&P 500. On the Nasdaq drifting higher as well. Some outperformance on the Russell. A ton of US data we need to talk about. Over in Europe, in the bond market, yields lower. A bond market rally. The 2-year in Germany down by about a basis point. On the 10-year down about 6. In the FX market off the back of that, the euro a whole lot weaker against the stronger dollar. A break of 107, 106.82. We're negative there by 0.5%. President Lagarde did not want to commit to a pause, but there was a strong suggestion the ECB is doing just that.
Based on our current assessment, we consider that the key ECB interest rates have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target.
Let's get over to Frankfurt, Germany with Maria today. Maria, what stood out for you?
Well, Jonathan, as you say, it is a rate hike. It was interesting to hear from the head of the ECB say, I don't want you to think the debate was antagonistic, but it was obviously not a consensus decision. And then she pointed to the solid majority. To me, I thought it was very interesting going into this meeting, as you say. The market really picked up on this line, which said, of course, if you have interest rates at a, quote, sufficiently long level for a sufficient duration, you could have a substantial contribution to a timely return to inflation to the 2% that was seen potentially as maybe this is it. Having said that, and again, this really stood out to me, she was given two opportunities to put this debate to rest. Is this the final hike from the European Central Bank? One, she was asked directly, is this the end of it? And she cited a theater play where she says, well, a door can be open or closed, but that is a theater play and this is life. And then secondly, she was asked, have we reached that peak level when it comes to rates? And she said the European Central Bank could not determine that. So to me, that was striking that perhaps given that opportunity to perhaps settle this debate, she did not. Again, she also said from now on, this emphasis on the data dependency continues to stay. The central bank obviously who has to deal with inflation. We know there were changes made to both the forecast that would point to higher inflation and lower growth. She was asked about stagflation. She was asked about recession. But obviously, at this point, this was not ahead of the European Central Bank that wanted to talk too much down the economy, but also clearly signal that, of course, the downside risks are obvious and they're palpable for this economy.
The theatre is supposed to be entertaining. There was certainly nothing entertaining about that news conference. Maria, thank you. Joining us now is Invesco's Alessio De Longis, Winnie Caesar of Credit Sites. Winnie, you were looking for a rate hike. We got a rate hike. What's next?
So I think that now you do have to have a base case of potentially a pause. We had anticipated another rate hike after this. When you look at Eurozone inflation, it is still objectively too high, even on a 3-month annualized basis, well over 3% if you average things out. And even though the economy is slowing, and as Lagarde pointed out, we're kind of in the midst of that now, those inflation levels really do need to continue to come down. So I would say a base case of a pause, but we do think that another hike is within the realm of possibility.
Alessio, a strong suggestion will get a pause. She read this one quote in the statement about 5 times. No harm to read it once again. The Governing Council considers the key ECB interest rate have reached levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to target. Alessio, did that statement sound like a pause to you?
It's meant to suggest a pause, but I think she did the right thing in not committing to it. While my base case is that rates are going to stay here over the next 6 months, that's my base case. But I do think that the risks, if anything, are tilted towards another rate hike, not towards an immediate cut in the next 6 or even 12 months. Yes, the economy is weakening, but it was a split decision. It was a debate. But if you really look at an unequivocal interpretation of the mandate, you can't raise your inflation forecast for every single year of the horizon down to 2025 and not raise interest rates. And I think given what commodity prices are doing, what food prices are doing, and you alluded to it, the strength that we're still seeing in the U.S. economic data, which we know will tend to lead, as they've done in this cycle, also European data, the risks are tilted that this cycle is not done.
Let's talk about that strength in the U.S. data. 14 minutes into the session, equities are higher here. Mike McKee, upside surprise on U.S. retail sales.
However, John, we had some revisions to July that make the news not quite as good, but it does show the consumer hanging in there. Now, remember, retail sales are calculated by dollar volume, so no surprise we saw a big rise in gasoline stations, up 5.2%. We'll talk more about that in a second. But the rest kind of looks like back to school. Clothing store sales strong, electronics store sales strong. Interesting thing, real weakness in furniture stores. We have seen problems in the real estate business, so that probably accounts for that. It's something like 5 out of the last 6 months we've seen declines at furniture stores. Now, let's make something out of the gasoline story here. The question that everybody's going to ask is, how's this going to affect us going forward? And as you can see, until the pandemic, gasoline sales and non-gasoline sales, gasoline prices, non-gasoline sales sort of went together. Then all of a sudden we started spending a lot on both. And you can see the yellow lines there basically point to the times when gasoline prices rose a little bit and we saw retail sales ex-gas fall a little bit, or at least flatten out. But that's not what's happening on the far right-hand side. How long are we going to see gasoline prices going up without retail sales being affected? That is going to be the key question for the Fed in terms of how the economy is hanging in there. Other numbers out today, PPI does go up. It's an oil price story as well. 60% of the rise in goods prices during the month attributable to oil, according to the government. Initial jobless claims barely moving. And continuing claims, they only go up by 4,000. So at this point, the labor market remains strong. Americans are still spending money, but gasoline looms as a black cloud on the horizon.
Mike McKee, thank you, sir. Energy a feature of the conversation of the ECB in a higher inflation outlook. Mike McKee nailed it there as well. Brent crude 93, WTI 89. Alessio, you like stocks, you like risk, you like equities over bonds. You think Goldilocks, and that theme is here to stay into year end. Do you think this move here in crude could disrupt that?
This move in crude at the moment, I think, is actually validating that to some extent. You're not expected to see rising commodity prices when overall global economic activity is that weak. I think commodity prices tend to be more of a, especially energy, more of a coincident indicator of growth, while stocks tend to lead. So commodity prices here are validating a little bit of the move. Now, is that the perfect Goldilocks scenario? Well, not so much if you remain on the verge of raising interest rates at every meeting. But if it's actually eliminating the spectrum of the imminent recession, I think for risk assets, credit, and stocks at this stage, the ability to lower the probability of a recession further out into the future is essential, and that's what's supportive of risk here.
Winnie, is $93 Brent reflection of good things or a recipe for bad things?
I think that I would thread the needle a bit there. You know, we do have to consider what has driven crude over the past week or so, and that has been a reiteration of supply cuts. And we have to look through that a little bit in terms of central bank policy, as the Fed and other central banks are cognizant of commodity price increases, but not necessarily trying to manage their inflation mandate to those headline moves. I think that there's some mixed factors here. Heading into the fall, we had anticipated the consumer to start to slow down. There are a number of different factors, from student loan repayments to that drawdown of excess savings. It is encouraging to see that commodity prices are remaining stable, but they're also quite negative for the consumer more broadly, as you see that increase in energy prices pushing away from the ability to have incremental discretionary spend. So I think it's a little bit more of a nuanced and mixed picture rather than just commodity prices, energy prices higher equals good economy.
Commodity prices are up, the labour market's still tight, unit labour costs might be climbing as well, particularly in Detroit. It's going to be a fascinating day today. The data's behind us, US retail sales, jobless claims, a central bank decision behind us as well. In front of us, a big deadline for a deal between the UAW and Detroit's Big Three. The deal nowhere in sight, with less than 15 hours until the deadline. AMH joins us from DC for more. Morning, Anne-Marie.
Good morning, Jonathan. And that's right. We do not have a deal just yet. And come 11:59 p.m. this evening, that contract ends. And what we heard from Shawn Fain yesterday, the head of the UAW, really in his clearest signal yet, saying that there will be strikes. And unprecedented at all three of these big auto companies, Stellantis, Ford, and GM. Just they're going to be targeting specific plants, Jonathan. This puts the president in a very difficult position. We have seen a number of labor issues come to him in the Oval Office. What the president likes to do is be out front with the rhetoric, supporting labor unions. He claims he's the most pro-union president in history. At the same time, behind the scenes, we do know that the president would like to stop a strike. This is usually how he's operated, whether it was the ports or the freight railroad unions, Jonathan. We do know that a number of individuals in the White House are tasked to deal with this. Gene Sperling is the liaison. We know that Julie Su, the acting labor secretary, is monitoring it. And we heard from Jared Bernstein yesterday, his chief economist. He said they are encouraging everyone to stay at the table. Jonathan, as a president, it's not just an issue for today. This could potentially mean the president losing blue-collar workers that could vote for him next November.
Big story for us today, tonight, and tomorrow. AMH in Washington, thank you. This is what's on the table right now. UAW, big union, wants a 36% raise. This is the offer, according to President Fain. Ford proposed 20% raises over 4 years. GM offered 18%, Stellantis 17.5%. Winnie, a question that's dominated this program now for the best part of 2 weeks. Do you see this as the dying embers of a hot labor market, or something we've got to live with for the next few years?
Well, I think that there are definitely a lot of real problems in terms of labor supply that are probably going to keep labor markets tighter for longer than a lot of people anticipated heading into the pandemic and the kind of erosion in participation. Now, that being said, recent economic data and recent payrolls data have actually shown some upticks in terms of labor participation. So I'm not necessarily convinced that this is kind of the dying embers of a hot labor market, but I do think that we are starting to reach an inflection point that should put the labor market into a little bit more of a balanced state.
Alessio, what does this mean for the viability, sustainability of some of these industries? I'm not just thinking about autos, I'm thinking about airlines as well. Do you think really they can pass on these costs to consumers, or ultimately they've got to eat this and margins are getting hit?
I think margins will eventually have to suffer here. I think the point that was made on the rising labor participation and some of the relaxation on the costs will be more evident over time. The increases in the labor participation rate are quite meaningful, and they're not only indicative of better supply, but also overall optimism among consumers. But ultimately, I think it will not be possible to keep passing costs onto end prices this way, and margins will have to take a hit. While bullish, as we said, on the overall economic picture, margins are still wide, and given how tight labor markets are, and we are towards the end of the cycle, a compression in profit margins is the longer path ahead.
Alessio, thank you, sir. Alessio De Longis and Winnie Caesar on three important stories there. The ECB, the latest data out of the United States, and that negotiation between UAW and Detroit's big manufacturers, the big auto manufacturers. Your market right now looks like this. 23 minutes into the session, equities doing okay, up by 0.4% on the S&P 500, higher here by 0.2 on the Nasdaq 100, and some outperformance there on a Russell. From New York, your trading diary up next. Twenty-five minutes into the session, stocks just about positive across the board here. The equity market on the S&P just about positive by 0.4%. That's the price action. Let's take a sneak peek of the calendar the week ahead. President Biden discussing Bidenomics at 2:45 Eastern. At midnight, the UAW strike deadline. Next week on Tuesday, President Biden in New York for the UN General Assembly. Wednesday, we get a Fed rate decision and Chairman Powell news conference. On Thursday, another round of jobless claims and existing home sales. The data so far this week, so far, so good stateside. Let's see if that changes. From New York, that is it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.